Friends, the RBI governor has just announced a 50 basis point rate hike. How will the stock markets react to this announcement, and what is the outlook going forward? In this video, I'm going to discuss exactly that. Well, the RBI has raised rates by 1.40% since it started raising rates, and we now stand at 5.40, which is the highest since late 2019. Will the stock markets worry because the cost of funds is rising? And as I've been cautioning you on my social media accounts, the interest rates or the cost of funds are going to rise, and that is likely to result in some demand contraction. But is there a ray of light here? Is there a silver lining in the cloud? In my humble opinion, yes. And in this video, I'm going to present my 2 bits on the same. You see, if you've seen my videos long enough and you know the interest rate arbitrage theory, the cash carry theory, if country A is offering 10% interest and country B is offering 8% interest, all other things remaining constant, money will flow out of country B, which is paying 8%, go into country A, which is paying 10%. This is called the cash carry trade, interest rate arbitrage theory, call it what you will. Now, last evening, the Bank of England raised rates by 0.5 basis points, their most aggressive in 2.5 decades. The US Federal Reserve, we know, has been raising rates. So the RBI did not really have any choice. They had to raise rate, otherwise money would have flown out of India into the other developing markets. And this is actually a positive. By raising rates, the RBI is actually signaling that it wants to keep foreign money inflows into the country, entrenched into the country, and stem the outflows. Which is why the USD INR, the United States dollar versus the Indian rupee, tested 80 plus levels and has fallen back marginally. Whether it will go up or not, that is besides the point. That's a matter for another video altogether. But what you are seeing is that the currency market is indicating that they are taking the interest rate hike in its stride. The bond market, bond yields have basically settled down. They've eased significantly lower than the 7.5+% that Indian benchmark bond yields were giving. And equity markets for their measure have seen the index, the Nifty, making a higher high and higher low on the daily chart. Now, coming up on your screen is the chart of the Nifty, which I have basically kept very simple. I've drawn two trend lines. One is connecting the tops and one is connecting the bottoms. We have a falling tops since October 2021. That pattern is undeniable, but the Nifty is attempting to go towards the top, and whether it will break out or not, time will tell. One thing is for sure, the closer it gets to the upper trend line, there will be higher volatility. The lower trend line indicates that there's been a lower top and lower bottom formation also after the market peaked in October 2021. But as per the classic Dow theory, a 20% fall is a minimum criteria for the onset of a bear market. We avoided that 20% decline. If you were to take a 20% decline, we should have gone below the 14,885 odd levels. So by the skin of our teeth, we have just about managed to avoid a bear market in the Nifty. Where the Bank Nifty is concerned, it did not even breach the low of 8th March 2022, which the Nifty had reached. Now, if interest rates were to bother any index, it would actually be the banking index first, because banking stocks are more interest rate sensitive. The fact that the Bank Nifty is outperforming the Nifty 50 tells me that the markets are saying, hey, this was a must. Raising interest rates was really no-brainer. There was no choice, and therefore the FII inflows are likely to stay in the country. Number 2, look at the chart of crude oil prices. Anybody who's followed me long enough on social media knows that I have never subscribed to the super cycle theory in commodity markets. And there you have it. crude WTI grade is fallen below $90. Can it go up again on geopolitical issues? Of course it can. It can flare up anytime. But the fact remains that all that talk which you heard about $200, $250, even $300 a barrel seems to be a little shaky at this point in time, and falling crude oil prices ease inflationary fears. Ditto for gas prices. Gas prices have also come down. They almost fell below the 600 rupees per MMBTU on the MCX, have bounced back again, but are nowhere close to their peak after the Ukraine war started. Many of you must be wondering about the scary pictures that you're seeing on social media about many European countries switching off their lights in winter and cutting down on gas consumption because the Russians are holding back gas supplies. Now, the way the market looks at it and the way you and me look at it may be a little divergent. From what I see, the market saying, hey, the consumers, the buyers of gas from Russia are saying we will rather switch off the lights than succumb to your blackmail. And therefore, the markets are going up. Guess what? Between your opinion and the markets are always right. So let's go with the market. Net, will the markets worry with the rate hikes? Of course, there will be a little bit of discomfort because your EMIs are going to go up, but depositors are also likely to get higher deposits on their fixed income. And there could be a little bit of demand contraction, but the markets seem to be cheerful, and that's all that matters. On this cheerful note, I'll bid goodbye to you, not before reminding you to click like on this video if you liked what you saw, subscribe to my YouTube channel if you haven't already done so, and hit on the bell icon to receive instant alerts about fresh videos being put out here. Good, bad, or ugly, I always look forward to your feedback in the comment section. Help me reach out to fellow like-minded smart investors and traders like yourself by referring my video to your family and friends. Wish you all the best. Have a very profitable day. This is Vijay Bhambwani signing off for now. Bye-bye.